Thank you both for your testimony. Mr. Adams, thank you for sending it in advance. And I read it, and it didn't provide for a lot of optimism at the end of the day. But I appreciate the insights. And certainly, while the precipitous decline in oil prices has benefited oil importing economies by raising household disposable income, by lowering inflation, by increasing market competitiveness for products produced in these economies, that same decline in prices has put oil exporting countries under significant pressure, particularly those exporting countries that either lacked the foresight or the capacity to diversify their economies. And so for these countries, loss of oil-related revenues and oil-related economic activity can be catastrophic, and I want to talk about that a little bit with you. But in one sense, that shouldn't be a surprise. Countries that are and have depended on revenue from oil as its almost singular source is vulnerable to its price. And the more they depend, the more they're impacted. Mr. Khan, thank you for your testimony. Now, from a foreign policy perspective, it strikes me that low oil prices might be a forcing function for economic diversification. But this is not the first downturn that many of these vulnerable countries have endured. So do you see opportunities here? As we were talking, and I agree totally with Senator Cardin vis-a-vis Venezuela, which this committee has had actions on, I would think international financial institutions would be advocating in these more vulnerable countries because of their dependency on oil for policies in support of economic diversification. Is that something that you see as an opportunity to happen?
Well, I absolutely do think it is an opportunity, and I think when a country, as one of these countries, respond to a decline in prices promptly with an economic adjustment program that seeks, the sort I talk about in my testimony, it absolutely. The sovereign wealth funds can provide a buffer to allow for that adjustment to take place because these things do take time, and I think it can be hugely positive in terms of long-term growth potential. It can be a forcing event to get rid of these very distortive subsidies. But I think the honest reality is that in many cases there are strong political incentives for these countries to kind of delay, right? To convince themselves that prices will come back up, that the deals that have to be cut to live with lower oil prices within the country are too difficult, and to spend them and to not be willing to talk to the international community until it's really quite late in the game.
And isn't that then the leverage moment for these international financial institutions, because they may not want to do that and may be recalcitrant because of their expectations that prices will rise. They won't have to change their operating. But it seems to me that that's the moment that the international financial institutions should leverage to try to get them to do so.
It's what they should be doing, and to give them credit, I think the IMF is making a real effort right now to get out to the oil exporters and to have exactly this kind of conversation with them. And there have been, at least from press reports, some noticeable successes with Nigeria, with Uzbekistan, Kazakhstan, a few other countries. But I think there's still a stigma to coming to the IMF. I think there's sometimes legitimate concerns in these countries that to do so almost is a signal to their private sectors that things are worse than they seem. And so certainly to the extent the international community, the G20, including the G20, which Tim can talk to, can try and find ways in which to facilitate these discussions, it's all for the good.
Now, in the context and a flip side of this, in terms of our use of peaceful diplomacy tools, sometimes when we cannot get countries to observe the international order and impervious sometimes to international opinion sufficiently to get them criticism, to get them to move in a different way. And our use of our aid and our trade hasn't induced them to move in a better direction. Sometimes we turn to sanctions as a use of peaceful tool of international efforts. And so I think about Russia, Ukraine, Crimea. I think about Iran and its nuclear program, but beyond its nuclear program, what they're doing with the Houthis in Yemen, what they're doing in Syria, what they're doing in expansion of intercontinental ballistic missile technology. And I say to myself, Obviously, the precipitous drop of oil has a multiplying factor in those economies. I think that's a fair statement. While sanctions are existing, there's a multiplying factor. Is there, and I offer this question to either one of you or both, do you see a point, I think maybe it was you, Dr. Khan, that called it a fiscal break-even price at which Russia finds itself unable to sustain its foreign policy? Is there a point at which the Iranian regime might be unable to sustain policies for support for Assad, Shia militias in Iraq, the Houthi insurgency in Yemen, the financing of billions of dollars to Hezbollah and Hamas, and in Venezuela, which has another challenge to it, one internally, but it has been giving free oil or largely subsidized oil to countries throughout the hemisphere. That has an even bigger ripple effect at the end of the day. So could you talk, either of you or both of you, talk to us in that regard? How do you see when it is that they can no longer continue, that they're going to have to alter because of fiscal realities some of those policies?
Well, we have with us, and we can submit for the record, current break-even fiscal points. But as the spectrum goes, Iran is pretty close to the bottom. Our latest estimates are about $80 a barrel for Brent, and probably coming down. And in many countries, it's coming down simply because of the fiscal adjustments they're putting in place. So some of them have been quite large, over $100, $110, $120 a barrel, and have been going up over the last few years, from about 2000 up until about 2012, because of the spending sprees that went on in many of these countries. But they're starting to see an adjustment. I think we're a long way from creating that kind of pain, especially in Russia. Although they are blowing through their reserves pretty quickly, and by the end of 2016, there'll be maybe $15 billion left in their reserve fund. As you get into 2017 and a new election cycle, they'll be forced to take even further measures. They've been walling off military expenditures and focus most of their cuts on social programs and investment. At a certain point, they'll have to rethink that mix. But I want to go back to your point about diversification. The best job among the consulting business now is to have an account in Riyadh. The airplanes out of Dubai into Riyadh are full of contractors trying to sell diversification. The Deputy Crown Prince, Mohammed bin Salman, who's actually doing a tour of the U.S. soon, is leading that effort to try to diversify the Saudi economy. I think they're very serious about it, and I think the resources put behind it, they see what's happening in UAE, which is diversified, in Oman as well. But all of these countries, of varying degrees, are being forced to put in place appropriate adjustments. Some of it is by design, some of it is well thought out, some is haphazard, and some of it will be recklessly done. But Iran, I think, is not one I worry about in the short term, and I think Russians have enormous durability to withstand these prices for some period of time.
Mm-hmm. Let me pick up on the Russia point, because I think it illustrates some of these trade-offs. So the fiscal break-even is a static concept. It's sort of saying right now, what is the price with the policies we have in place? What is the price we need to make things balance? And so for Russia's, they're hemorrhaging money at this point. Now they had large asset balances they could draw down, and of course in the Gulf as well, they can do this for some time. And so certainly you can try and calculate how long do they last. And a lot of these sovereign wealth funds, including in Russia, is not fully transparent. How much is there, how much is liquid and usable. And of course the politics of whether it can be used can be an issue as well. But then as you get lower, then you have to ask, well, what are the next policy steps you can do? Is it cutting investment? One of the things we see in Russia, which I think is indicative of other oil exporters, but is particularly an issue in Russia, is that if you have a country where the majority of their export revenue and budgetary revenue comes from oil. So the budget's in domestic currency, in rubles in this case, oil's sold for dollars. A devaluation helps the budget. So if you say, put together a budget in the fall, assuming $55 a barrel, that is as much a political statement as much as an economic judgment, and saying we're going to try and balance interests and put together a budget that maintains social, maintains our politics at this price and allocating resources then for the military, for social spending and the like. And then prices are 30. What do you do about it? You can renegotiate. We saw that in Saudi Arabia in some sense, announcements about change of the safety net, which in a sense was recalibrating the budget to a lower price. And that's one way to close the gap. In Russia, easier monetary policy by depreciating the exchange rate and raising the domestic value of that oil revenue shifts money to the budget. It is a way of, easing those pressure points. Now, where does that money come from? It's a tax on consumers, and particularly those with fixed income. So that's a common kind of element. Many of these countries are particularly those that don't have pegged rates. The Gulf, there's a lot of pegged rates, and changing it would be very disruptive. But where countries have flexible rates, that is one element of the dimension that feeds into the politics very readily, because it is a shift of resources. Now, one of the things that's striking about Russia...
It's been a great explanation, but probably going to end it